Well, hey there, everyone. Happy Friday, December 12th. We made it. Friday is here. Hope you guys are all doing well. My name is Dave Keller here at Market Misbehavior, coming to you from a very flooded Redmond, Washington. So I appreciate, by the way, all of the very kind comments and words of support. The good news about living in this area, we're used to having a lot of moisture around, right? We're used to a lot of rain. But this is severe. I mean, in terms of the amount of rainfall that's happened so quickly, the rivers are overflowing. So the good news is we get flooded in some way about once a year. Usually this time of year, the rivers will swell. The good news is it makes the farmland down in the valley really awesome, which is why farmers keep setting up farms there, even though it just gets flooded every year. It keeps the soil pretty good, is what they tell me. But this one's a little more than normal. So we did get cut off from the rest of civilization there for about 36 hours. So one of the bridges just opened up, kind of the main bridge over across the plain is high enough that it kind of just opened. So we are reconnected with civilization. So that's good. And of course, hope everyone. I mean, in some areas they're dealing with unusual amounts of flooding for sure, and certainly in this area all around. So. Hope everyone is staying safe and getting through this period okay. But I appreciate the kind words you shared. Luckily, the Keller family we're in good shape. We've got a good setup here. We're up on a rise and no issues, thankfully. Having said that, kind of a cloudy day, if not an incredibly cloudy day market wise, right? Broadcom comes out with the disastrous announcement that things aren't great and their business is not as good as you might think. And it's interesting, right? This whole AI narrative is built on, just kind of the optimism continuing, the euphoria translating from optimism about the technology to companies putting tons of money into AI infrastructure that starts paying off with incredible profits from something. And again, announcement like you get from Broadcom just starts to put enough of a question mark on that general theory that things start to struggle. Now, having said that, there were things that were up today. There were charts that look quite good. Some that you may even hopefully have in your portfolio. If you're following the tools and techniques that we talk about, you're finding good charts and able to follow those. So I'm finding good charts, but when the AI stocks on a day like today certainly look pretty vulnerable here. So what we'll do today, we'll check in on some of the quick update on the market conditions. Again, on a Friday, I'm usually more focused on some other things. We'll do a mailbag episode here. And then I like to take some time after the markets are closed over the weekend to really dig into the charts and how the week finished off. And I'll provide my most important updates to my Market Misbehavior Premium members this weekend. As a reminder, always a good time to become a premium member. You can go to marketmisbehavior.com/premium for more info on our premium memberships, and use the code YouTube when you check out for 30% off your first 12 months on any plan. So kind of a big distribution day. This is after Thursday with a nice grind higher. The volatility obviously has remained fairly low. And even though the VIX still below 16 after today's sell-off, so we're still in a low volatility environment, but today was unusual in terms of the significance of the move relative to normal expectations while volatility is this low. The S&P, which closed yesterday at 6,900, almost got to 6,800 today. We closed at about 1.1% lower on the S&P, finished around the lows of the day at 6827 and change. The NASDAQ composite a little bit worse, down 1.7%. Mid caps and small caps all pretty similar, down 1 to 1.33%. The VIX again slightly higher. It did get up almost to 18 earlier in the day, but settled down through the course of the day after that initial drop, sort of choppy market. But generally, the volatility lightened up. Interest rates generally moved higher as bonds sold off along with stocks. 10-year yield is pushing 4.2%. The long bond yield around 4.86%. The dollar index moving a bit higher here as well. In the commodity space, gold was one of the very few things in the commodity space that finished higher after a stronger open, kind of traded much lower around lunchtime. Compare that to silver, copper, crude oil prices, natural gas prices, which all ended up pretty good in the red. Cryptocurrencies generally kind of a risk-off move as equities sold off around the U.S. Open. Bitcoin currently trading just above 90,200 as we're recording this just after 2 p.m. Pacific time, 5 p.m. Eastern. You can see all 10 of the top coins in the red there. Sector-wise, actually kind of split here with how bad the major averages looked in terms of percentage terms. You can see what happened, right? If technology is flat for the day, this is a pretty decent day for the markets, right? And the benchmarks are probably slightly higher because you have about a split 50-50. And this is one of those times where the breadth and the and then the direction of the indexes are probably going to be opposed a bit because the market, the strength in those mega cap growth stocks, such a big part of the optimism fueling market conditions here. Technology today down at 2.9%. That is enough to drag the NASDAQ, certainly the S&P, and even the Dow lower because they're big enough names that have that exposure. Energy and industrials, second and third from the bottom. On the positive side, half of the S&P sectors were up. Consumer staples, one of the more defensive sectors at the top of the list, up 0.8%. Consumer discretionary and healthcare both up as well. Brett, there's a little more negative today. You can see about a 2-to-1 ratio of stocks down versus up. But here's the story, right? Tesla and Netflix were up. Everything else was flat to down. But this is what gets you. Broadcom down 11.4% at the close. NVIDIA down 3.3%. So the AI trade getting hit pretty good. We're not going to talk too much about the heat map, but I would encourage you to spend some time looking at this over the weekend. And what you'll see is this is the danger to this. And again, when people have said, no, it's not just technology, it's other things. You're right. There are plenty of things that are working, but the way that the math works out is if technology looks like this on a day, the major averages are going to be down. I don't care how many GE, Eli Lilly, kind of name Walmart and Coca-Cola, if they're all up big, the market's still down. The market as measured by the S&P is still down big if this is what technology looks like. I mean, this is what we're learning. Friendly reminder, this is a growth-driven market. The technology sector is over a third of the weight in the S&P is just this one sector. So it dominates. And so if there's this much, if there's this much of an uh-oh moment for the AI trade, if the sell-off in Broadcom is just the beginning, this is where deterioration can accelerate very, very quickly. Because if people get a sense the music is stopping, if people get a sense that AI is no longer a great bet at this particular moment, if people start recognizing, as we look a little bit brief, and I promise not to have too much of a market recap, but here I am kind of digging into it. But if we all decide that this bearish momentum divergence with Micron is a problem and not just Micron going higher and everything's fine, we start worrying more about this divergence, which it's not the only semiconductor flash in that pattern here. I think that's where I think that's where the NASDAQ can certainly lead the way lower. This is where breadth could still probably be okay, but it's not going to be breadth in sectors like technology that are the biggest weights. It's going to be in other things. So could be a great opportunity to outperform is to just lighten up on the AI trade and go elsewhere. And that's actually paid pretty well here in Q4 so far. So maybe there's just more of that to come. Those are some of the things we'll be digging into a little more deeply. I have to share this, by the way. I shared this on social media. So follow me on X, Facebook, Instagram, LinkedIn, Blue Sky. I'm on all those social media platforms and post charts and things randomly. But I asked ChatGPT to give me a cartoon of a smiling bull with that quote, and then Broadcom with that ticker as a plane crashing. This is what I came up with. I like it. Good. I mean, this is the reality, and this is the optimism that I see from a lot of bulls, and again, with good reason, because the markets have been going up, right? The indexes have been going higher, undeniably so. But again, if you are bullish here, particularly on the AI names in their current, with the AI trade that's worked, you're assuming that there's this transition from great promise of great technology to these companies generate profits. And that's where I think there's a bit of a question mark. And again, we'll see how things continue to play out. Those are some of the things top of mind for me. All right, let's get to some questions, shall we? We'll get back to market updates on Monday. We're planning a normal week next week. But for now, I want to answer some of the questions you guys have sent in. As a reminder, always the mailbag is always open on our YouTube channel. Use the comments section for questions. We would love to hear from you and hear some of the questions we've received just in the last week or so from viewers like you. Question 1, could you give us your Ichimoku Cloud analysis on the SPY? We hit the bottom of the cloud on November 21st. The cloud then turned red, now a bit green. What do we make of it? Let's take a look. So I actually have a chart set up with the cloud on there, I believe. Here we go. So the Ichimoku Cloud, this is a traditional Japanese charting system. And, you know, to be honest, this is a part of it, right? There's actually a couple different parts of it. This is the full Ichimoku Cloud. So the Ichimoku system is basically a trend following system with a pretty awesome history. At some point, I'll share deeper parts about the history, but you know, it kind of has a couple different components, and there are names in Japanese that would make sense if you know the language. But there's two lines that line up with the current market. Think of these as kind of trend following exponential moving average kind of thing. It's called the conversion line and the baseline. And then there's the lagging span, which is in green here, which is basically today's data plotted 26 days in the past. And then there's the cloud, which is made up of these two leading spans. And what's unique about the Ichimoku Cloud system is it's one of the few indicators that actually plots a projection out into the future. So this is actually plotted 26 days out. And so it's based on the current open, high, low close and some, recent trends. It actually projects forward where anticipated support or resistance might be. And that's why it's, you know, generally appreciated by traders that use it, is because it kind of looks forward a little bit and it gives you an idea of where you might anticipate support and resistance, not a static level as we normally think of. So the full Ichimoku system was really designed to be used on its own because it has a projection part. It has kind of a MACD PPO kind of thing, but then it also has this lagging indicator called the lagging span. And you'd use all three of those together to kind of paint a complete picture of a specific chart. And there would be names for those different configurations. Now, in the West, right, sort of generally outside of Japan and outside of like Southeast Asia, where the cloud system is used a little more often, here people often just talk about the cloud and just take that one piece of it. And because we already have other indicators that help us think about trends and moving averages and stuff like this. So what's unique is this cloud that's plotted in the future. And so on stock charts, it's kind of showed in this green if the first leading span is above the second one, if it's in red, if the cloud is trending lower and those levels are reversed. So I think what you had mentioned was this over here, it kind of, you know, turned red and then turned back green. So generally speaking, right, the cloud in green is bullish because that tells us that the trend is positive. The cloud in red is bearish because it tells us the trend is negative. And before you think, well, hold on, it's way later. Remember, this is always plotted in the future. So this breakdown here is where the cloud actually turns red because we're looking 26 days out. So it's actually pretty helpful at just recognizing, you know, if you know nothing else, if you just bring up a chart and look at the cloud, you'll be able to immediately answer the question, is this an uptrend or a downtrend? And then start to make subsequent assessments after that. So, step one, I would say bullish in that the cloud is in a positive configuration. It did turn kind of slightly negative as the price pulled back here, but as we've recovered, the cloud has turned back positive. You had mentioned this part, right? So one of the other ways you use the cloud is you generally assume that if the price is above the cloud, it will find support there. So pulling back into cloud support is often a really good tactical, buy point or tactical bullish reversal. So the fact that we're retesting the lows from October and we're testing the cloud support kind of suggests this is a good bounce. Now, what it also means, and this is the third way I would use the cloud, is if we break below the cloud to the downside, that's pretty bearish, right? Generally speaking. So 3 things you look at with this chart. Is the cloud currently in its, furthest out value? Is it green or red? Is it bullish or bearish? It's bullish right now, which is a thumbs up. Number 2, have we pulled back to the cloud? And if so, you probably expect to bounce. We did see that back here. Currently, we're well above the cloud support, which means if we do sell off, depending on how quickly we sell off, we can get an idea on the SPY around 670. kind of looks like a general area of where we would find support within that cloud. The third piece, watch for any break below, right? The last time we had a break below the cloud was after the February peak where we did that. So if we would sell off, SPY below 670, kind of clearing that cloud to the downside would be very negative. That's how I would use the cloud and think about it. I don't use it very often. But again, you can't use everything. And I think one of the sort of ways that you evolve as an investor using charts is you often, at the beginning, you have a very simple and underdeveloped toolkit, and you make a lot of mistakes and lose money. Then you learn a lot about technical analysis, and you use way too much, and you've got way too much lines and indicators, and you feel like you're on top of things, but then you start to realize it's just a lot more confusing than anything. And then what I've seen is there's this natural third phase where you really want to get to, which is now you start simplifying again, and you get down to the stuff that really helps, right? What's the most important stuff? But then you have these other indicators that in certain situations you go, oh, I should check the cloud and see where we're at. So I have other kind of charts down here that I don't look at all the time, but like every once in a while, just like the chart looks a certain way and I go, all right, I want to just think about this a little bit more. Maybe just look at this on a couple different indicators, just to sort of, get a better sense of how I might want to approach this. And that's where I bring the cloud in there. For some people, this is part of their initial toolkit, and that's fine, right? At the end of the day, the tools and techniques we use should be about helping us answer the questions we're trying to ask in our own portfolio and in our own process. So it's a very fascinating technique. There are great books written about cloud charting. I'm going to make a note to actually put a link in the notes for this show with a link to one of those. Ichimoku book. Just so you can for further reference, and Stock Charts has a really good kind of basic primer on that as well. If you go to the Chart School, which is their free portion of their website. Next question: how far back in time would you go before divergences start to lose meaning? Yeah, no, that's a great question. And how to answer that? I mean, so the answer is, honestly, the answer is it depends. It's hard to say. It's hard to say how long. And I'm trying to think of a good example. Honestly, maybe just the chart of the SPY is a good example. Yeah. All right. So let's clean this up a little bit. Take this question off your screen. All right. So the question was, how long until divergences don't matter anymore? So there's no hard and fast rule. And I'm not a fan of anytime someone says a divergence is good for X bars or X days or X months or whatever that thing is, I feel like you're implying a precision to the timing of technical indicators that I don't think holds up to a lot of scrutiny, right? So I think this is a little more subjective. I think this is more of the art part of technical analysis versus the science of it. There are some statistical trend following methods we can use to measure momentum and all those sorts of things. The amount of time, whether something is a valid divergence and how long it's meaningful, for me is not of a time thing, and it's more how the chart evolves. And let's look at this example. Here's the SPY again. And we're looking off of the April low, and I'm looking at like this example right here, right? So here we have a divergence, okay? We have higher highs July into August. We have lower momentum. So that's a bearish momentum divergence. And once we pull back here and we have a clear high surrounded, followed by a higher high, and then an RSI that is trending lower, classic bearish divergence. So is there an amount of time where I think that is relevant? No, I think the chart very soon after divergence does one of two things. Either it confirms the divergence by the price breaking down and following through on the implication of that bearish divergence, or the market moves higher on stronger momentum, kind of negates that divergence. All right, it tells you, nope, that was wrong. Trend is still higher. And again, some people, swear that certain indicators are just always right, and whatever approach they're using is never wrong. They are lying to you and or lying to themselves, probably a little of both. There's a cognitive dissonance where we really want an indicator to be right all the time. I'm a little more of a realist in terms of actually experiencing these things. Like they're just not right all the time. So technical analysis is not about being right all the time. It's about when you're right, you stay right. And when you're wrong, you admit that quickly and adjust. So for me, what happened after this? Well, the divergence is right, and we need to be, getting more defensive. Would be the S&P selling off, making a lower high, breaking down, the RSI breaking down through 50, breaking down through 40. None of that happened, right? After that, we didn't even make it below the 21-day EMA. About 2 weeks later, we're actually making new highs. We're making new highs on weaker momentum. So it's almost like the divergence continued to this point. Then we start breaking higher. So we could probably do this too. And here we kind of have 3 higher highs and 3 lower peaks in momentum. Then look at what happens here, right? At this point, like, it's no longer a divergence, right? The RSI is actually breaking out. It's becoming overbought again. We're still making new highs. We're making new highs on stronger momentum. And that's the bullish way that a divergence like this is resolved, is the uptrend just continues. So, again, I'm not going to lie and tell you anytime there's a divergence, you want to get defensive because it's going to be right. It's not right. I mean, all the time. It's right more than it's not. And I found it's incredibly valuable if you validate it the way that we just described. So for me, things like divergences are leading indicators. These are things that tell you a major top might be coming, but then it doesn't mean you ignore the other steps to that, which is, all right, how do we validate that it's a major top? Well, we have to look for a breakdown in price. We have to look for a failure of moving averages and trailing stops to hold. We have to look for the momentum to start to really break down, which suggests that they're selling. None of those things happened here. What did we see? We saw the opposite. We saw the market continuing higher and the momentum start to improve, which suggests there's actually a new influx of optimism, new influx of buying. So by mid-September, I don't think that divergence is relevant anymore because the structure has changed. So for me, it's not a how far back in time. It's soon after a divergence, you will know whether it's valid or not based on what happens with the price. And so I think as a leading indicator, do I initially make a bet thinking this divergence might be right? That is a more aggressive way to play divergences, right? I short a chart like that, and if I'm wrong, I cover my short. The more conservative way is I just wait, and if we break down, then I take the short position, and if we don't break down, I remain long. So how you actually trade it is really more up to you and how you want to approach indicators like that. Hope that was helpful. I feel like that should be a whole standalone video. I'm going to think about that one because hopefully that was a helpful walkthrough. All right, question 3. Dave, can you have an episode on 2026 investment strategies by looking at some long-term chart trends? I promise you that is legitimately a question that I received this week, and it's an awesome question because perfect time to mention a webcast we're doing next week, Wednesday, September, what month are we on? December 17th. 1 o'clock p.m. Eastern, 10 a.m. Pacific time. Winners, losers, and lessons. Your year-end investment review. You can sign up for that free event at marketmisbehavior.com/lessons. Every December, I do this exercise I've done for years. I call it the 10 questions. I ask a series of questions about performance, which trades were good, which trades were not. I ask a series of questions digging into market conditions, right? What did I get right? What did I not get right? Right? What surprised me? What made sense? And then a series of questions about process, right? How can I improve? Really thinking about how you can improve your daily, weekly, monthly routines. And then one final question on mindset and mental state and where I'm at after the year that just occurred. I have learned, having gone through that kind of structured review process every year, it has helped me really understand, appreciate the journey I'm on as an investor, because I'm still learning and still trying to get better at this and still growing. But I found in recent years, sharing those 10 questions, sharing some of my answers and encouraging you to answer them for yourself, super, super helpful. So in that webcast, we will be talking about a lot of that. We'll be talking a little bit about looking forward at the year to come. We'll be talking about lessons we learned in this year and hopefully setting ourselves up for some good decisions next year. So I would encourage you to sign up for that at marketmisbehavior.com/lessons. Friendly reminder for my premium members, you have the opportunity to share the answer to your 10 questions. That has been a really fun exercise I've done with a number of my premium members over the years. It gives me an opportunity to sort of see where you're at, and I will respond to every one of those with some follow-up resources and feedback on some of the answers to your questions, and kind of help you learn from that very helpful exercise. So again, great time to become a premium member here at year end. This is where I think it really matters to think about performance, think about process, and set ourselves up for some better decision making in 2026. So that's that. On top of that, I'm actually doing a year-end review with Grace and Rose at Stock Charts next week. We're planning to do that on Tuesday. I'm not 100% sure of the structure of that discussion because we just agreed to do it about 24 hours ago. But keep your eye peeled on Stock Charts TV's YouTube channel, because that's where you'll find more information on that as well. But I hope to see you at that webcast next week. I hope that helps you answer that question on your own in some way. All right, next question. Hi, Dave. In the market for a float plane. Sorry, bad aviation humor. Love that. Comments on growth versus value. I appreciate that. I would love to have a float plane. They're actually, as you can probably guess, with the water that we have around us, they're super popular here, particularly in the Seattle area. We live a little too far inland for that to be a super reason. I mean, I live about an hour east of Seattle, so out here in the hills, having a good Cessna would probably be better than anything. But yeah, on my list. Float planes are really cool. I've not flown one, but I've been in them a number of times, and they're just so much fun. It's a whole different style of takeoffs and landings that I would have to get a lot better at, but something to think about. All right, so your question was on, let me go to another chart here. Your question was on growth versus value. And you said IWF, which is the Russell 1000 growth ETF. And the other one you threw, IUSV. Yes, this is the iShares Core US Value ETF. So when I look at growth versus value, I usually use these two. And there are a bunch of ETFs that track these different indexes. There's no necessarily right or wrong way, but I usually use the IWF and the IWD. So we're doing a little more apples to apples. This is the Russell 1000 growth and the Russell 1000 value. I also, and the reason why I have this chart set up this way is I also do the pure growth and pure value ETFs. And these are the two tickers here. RPG is the pure growth ETF. RPV is the pure value. So what's the difference between these? Quick version is, if you think about growth stocks, which are, what's the stereotypical growth stock, kind of, in a growth phase, growing earnings, expanding, building out, probably not paying a heavy dividend, more reinvesting in the growth, and they're borrowing more than, paying money out as dividends. So borrowing a lot of money in a heavy growth phase. Value companies generally a little more mature, a little further on in their growth trajectory, more stable, not maybe in an aggressive growth phase, but more able to pay out, earnings back to, in the form of dividends back to investors. So growth stocks versus value stocks, talk a lot about that. But in reality, in 2025, there are stocks that actually have similar characteristics, right? Microsoft is an example, right? It's still growing, right? In terms of AI and all these new businesses, cloud and et cetera, right? So the evolution of Microsoft has continued through the present day. But it also has characteristics of value companies. It's a more mature company, right? Tons of cash around, not necessarily a huge dividend payer, but has more characteristics of an established kind of blue chip company. So a stock like Microsoft is actually in both the Russell 1000 growth index and the Russell 1000 value index, potentially, right? And a lot of stocks are actually double counted. So you kind of have growth and then you have value, and there's this overlap where some companies are considered both. These pure growth indexes and the ETFs that those indexes are based off of kind of ignore the stuff in the middle that's double counted, and it's only the growth stuff and only the value stuff, and that's what's represented. So a lot of times they have very similar movements. Other times they don't. We're actually coming through a 6-month period where they've diverged actually quite a bit, with the pure growth to pure value indexes topping out at the beginning of August and have been trending steadily lower since. Whereas the traditional growth versus value has actually made a new high around Halloween, end of October, and for the last 6 weeks has been trending lower. Excuse me. Having said that, both of these are now trending downward. So there is absolutely a rotation that has been happening, and I would say specifically the markets in like Q2, kind of post the April low through Q3 through the end of September. The market has had a very particular kind of configuration where technology was dominant, everything else was kind of lagging big time. November, December, it's had, and on October, November, December, the markets have taken on a bit of a different complexion, where a lot of other things like financials, industrials, healthcare, at times have all started to improve and do much better on a relative basis. On a day like today, you're seeing that where one of the growthiest sectors, technology, is down, while a bunch of value sectors are up. So we're seeing this rotation. I had interviewed Julius DeKempener yesterday. That's with my editor. My apologies. I've got a couple interviews with the editor, hopefully getting out to you very, very soon. I'll post those to my YouTube channel as soon as they're ready. But the last two episodes of my podcast, I think, were really good conversations. The one with Julius DeKempener, really talking about rotation. We dug into this particular issue of what we've seen with some of the rotations, how he's using that RRG as a way of visualizing that rotation. Some of the things we're looking for, both of us are looking for going into the new year. So yeah, I would say we've definitely rotated from growth into value as a large sort of change of character. If you've been all in on the growthy trade, what I've been telling people here for a little while is, on the way up, you're probably way too overexposed to the AI trade. We want to be looking for good charts in other places, particularly value sectors like industrials, like healthcare, like financials. That's where we've found really good charts, and that's where we've been pointing people to anytime they would ask us. So look for that interview with Julius DeKempener, maybe for some more color even on that discussion. All right, what will most likely be the final question? Delta Airlines, DAL, made a new 52-week high today. RSI crossed 70 on Wednesday, moving averages in the proper order. Do you wait for a pullback or buy now? Standard disclaimer, nothing of what I'm about to show you represents a recommendation to do anything. And I have a disclaimer that I show at the end of the show with that sort of language for a reason. My goal is not to recommend or tell you what to do or tell you what you should do with your capital. I'm trying to give you the tools and techniques you use so that you can make better, more informed decisions and have a better decision-making process in your own portfolio, and try to learn from some of the lessons from me and others that I speak with. So that is my goal here. So your question is, we made a new high. Here's Delta, moving averages in the proper order. Do you wait for a pullback or buy now? Yeah. So a couple thoughts on this, right? I would say with the airlines, I mean, the airline space is actually a little different, right? So I mean, different charts in this space actually look very different. So like here's Southwest kind of breaking out. Here's America Airlines, not to new highs, but getting up there. Here's United, still underwater, just below 110. Not a bad chart, but still waiting to break out. Here's like JetBlue, which is just getting above its 200-day moving average after being below it for almost a year. So they're not all the same right now. I would say this is one of those times where not all airlines are considered equal in terms of their technical configuration. Alaska, which is the biggest carrier here in Seattle, it's had a bearish engulfing pattern today, for example, with a big bearish outside day as it attempts to break above the 200-day. So for Delta, I would say probably one of the more constructive charts out of all the airlines, and it's because of this period right here, right? If you look at this point, this what do we do? Right? See sort of this. So we have an accumulation phase, a rally phase, higher highs and higher lows. We have a consolidation phase. Highs and lows are fairly even. And then here at the end of November, we break out of that consolidation to the upside. So I see this as a stock that has transitioned from a stable kind of sideways consolidation phase to an accumulation phase where demand outweighs supply. And so I would consider a chart like this, innocent until proven guilty. It's proven that it can break higher. It's testing the January and February previous highs. For now, appears to be getting above there. So that's sort of the long-term thing I would say would be that, right? Constructive. Now, in the short term, right, the difference between is it a positive structure, the trend is good. Is today the day where I might take a new position in Delta? Probably not personally, and I'll show you why. So if we zoom in a little bit, look at like the last 9 months. Here we have what's called a dark cloud cover candle pattern, right? 2 bar pattern. Day one is up. Day two, higher open, close is at least 50% of the way through day one's open to close range. That's a bearish candle pattern. We've been overbought. We're actually very close, just finished above the overbought level, but very close to pulling back a little bit. It's kind of like what you had here. You didn't have the exact same pattern. We had a gap here, but you can see a similar kind of thing, right? We trade up, we're overbought. We come out of that overbought region. We're down for a couple weeks before the uptrend resumes. Kind of the same thing here when we're testing the 200-day. We had this kind of distribution pattern. It's not a real specific candle pattern, but finding resistance at the 200-day overbought, and then we come out of here, and it almost looks like a similar setup here. We have a bearish candle pattern. We're overbought. Coming out of that overbought region probably tells me to hold off a little bit because a pullback is probably going to give you a better entry point. This is where I would say, even as a longer term, more of a position trader, it still makes sense to look at overbought and oversold conditions. It still makes sense to look at candle patterns. Whether or not that defines your investment process, can it give you some tactical color as to whether today is the right day to pull a trigger? And what I've learned is when I find dark cloud cover patterns or engulfing patterns or a big shooting star candle pattern like I see here, it doesn't tell me that the stock can't eventually be a lot higher, which is where it's at now. It just tells me today may not be the day because we're probably going to have some sort of pullback. So with this, given the candle pattern and the overbought conditions maybe breaking down as early as Monday, I probably wait to see if there's some sort of pullback and opportunity to buy on a short-term pullback. That's often a much better place to initiate a trade to the upside. So for me, in my process, I would probably wait a little bit. But again, the longer term structure, I think pretty sound, right? We're making higher highs and higher lows. We broke out of that base. I think there's plenty of upside potential for Delta beyond what we've seen so far. But that doesn't mean today maybe necessarily is the right time to make that call. That's it. Some fun questions, you guys. As always, I can't tell you how much I appreciate you taking the time to share your questions in our mailbag. Please, if a question came up as I was answering these today, use the comment section on our YouTube channel. As a reminder, don't forget our upcoming webcast next week, Wednesday, 1 p.m. Eastern, 10 a.m. Pacific, called Winners, Losers, and Lessons, your year-end investment review. You can sign up for that free event at marketmissbehavior.com/lessons. Have a wonderful weekend. Please enjoy wherever you're at. Hope you find joy and peace and safety wherever that is. And we'll see you next week. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.